Okay, so I'm supposed to start from reading 71 now, right? Okay. Now this MTM we have already done. You remember mark to market. I think in the first session of derivative itself I did. Forward futures. That time itself mark to market is also done. Okay. Then this future price. Actually, this future price is a part of FRA only. See, I'll just quickly brief you what is FRA, forward rate agreement. When you say forward rate agreement, FRA, that means forward means you are locking in advance, but what? Not the price, the rate. So here it's like after 3 months, you are agreeing to borrow at some rate. Okay, let's say at 10% rate for the next 6 months. So 3 to 9 is 6 months. So today you are entering into the contract that after 6 months you will borrow at the rate of 10%, $1 million. Okay, and that is for 6 months. This is FRA. Okay, FRA is an over-the-counter contract. Okay, FRA is an over-the-counter contract. Now, what is future price here? Now, because this is over the counter, and what is your intention? Why are you entering into this contract? Because you believe that if you lock the rate at 10% now, okay, if you lock the rate at 10%, okay, if you lock the rate at 10%, your prediction is that after 3 months, the 6 months interest rates will become 11% or 12%. So everybody else is borrowing at 11%, whereas you are borrowing at 10%. So you are getting the benefit of 1%. This 1% will be your profit. So that is your expectation, thinking that the interest rate will go up. Now the same predictions when it comes to exchange traded contract, there it is called as future price. Future price. It is called as future price. So what is future price? Future price is equal to 100 minus 100 into market reference rate of A comma B minus A. Okay. So now what does this mean now? A comma B minus A. A is this time period 3 and B is this time 9. So B minus A means after, so it is like this 100 into MRR. Okay, MRR after 3 months for 9 minus 3 months. That means 100 into MRR for 3 months, after 3 months for 6 months. This is what it means. So here 100 minus, right? So 100 minus. So 100 minus, imagine it is 10% after 3 months for 6 months. So future price becomes 90. Okay, now when the interest rate goes up 11%, then what will happen? 100 minus 100 into, it will become 11%. So in that case, it will be 100 minus 11, that is equal to 89. Okay, 89. So here you see when the interest rate is going up, the price is coming down. So this exchange traded product future price is for those people who believe that the interest rate is, if you think that the interest rate will will come, it will go, the interest rate will come down, let's say. So if the interest rate is coming down, 100 minus 100 into 9 percentage. So from 10, it goes to 9. So 9 percentage is 9. It will become 91. That means you are buying the future price at 90. You predicted that the interest will go down. Interest went down to 9 percentage, and it becomes 91. So you are making 1 rupee profit over here. So it is the same concept of interest rates only, but slightly modified in the exchange. So, but then in the exchange, you will make profit here. If the interest rate is going down, the price will go up. Like here, 9 percentage interest rate gone down, the price has gone up. So you will make profit. Okay, so this is how it will happen. Have you understood future price? That means it is an exchange traded version of forward rate agreement only, wherein we are buying and selling, based on this price, not based on rates, but that price is moving based on the rates only. Okay, this is future price. Is it
So
okay?
the interest rate and price is moving in inverse.
Inverse relationship. Correct. So in the OTC contract here, if the interest rate is going up, you are making profits. Okay, here, if the interest rate is coming down, then you are making profit. Okay.
Okay.
Like, how does it happen actually, as in practical? Like how do we buy it?
Just like but the just like how we buy futures
Okay,
for
futures.
other
Okay.
underlying assets, for Reliance and all those. But liquidity all will be very low for this kind of products,
Okay.
because everyday interest rate is not going to change highly, right? So for that reason, the movement
So
will not happen.
like our aim is to buy at high interest rates and then sell it at lower.
Yeah, at the lower interest rate, the price will go up and then you will sell it. Yes.
Okay. Let's note it down.
Yeah, this is okay. Noted down.
And so like here you go B minus A, 9 minus 3. Like what do we do with this information? With 6, like 3 comma 6.
That means the interest rate for after 3 months, for 6 months, that interest rate, based on that interest rate, the movement is happening.
We don't have to solve it, right? 3 comma like
No, we
that
don't
is
have to solve. That interest rates will be given.
okay. There is saying that it
If
is
we have to solve also,
yeah.
how we solved over here, that way. That means that previous sum here. But they will not ask you both. Okay. Here we solved. You remember this one? It was like this. I'll tell you how we solved. It was, see, uh, 9-month MRR is, see, it is like this. After 3 months, for 6 months. Okay, this is 6 months. So they mentioned that 9 months MRR 9 months MRR is uh, 9 months MRR is 1.2 percentage, and 3 months MRR 3 months MRR is 1 percentage.
1%.
So how do I find out this one? This is forward rate after 3 months for 6 months is equal to 1 plus 1.2 percentage. This is
1.2%
for
by
12
12
months
into
into
9.
for 9 divided by 1 plus. This way we have to find out. This is for 1 percentage for 12 months into 3. So when we will discount, we will get for 6 months. So whatever answer you get, that is for 6 months,
So
which you have to
multiply by.
annualize it.
Right.
So this way we have to find out. But they will not ask you both.
Okay.
Okay. I have not seen any question actually in the derivative website also pertaining to this, but then see, you never know nowadays, like the way they are asking questions, we never know from where they will pick up questions. Okay. See, here they mentioned MRR after 6 months for 6 months is 3 percentage. So this is 3. So 100 into 3 percentage is 3. So 100 minus 3 is what? 97. So here 97.
Yeah.
And then the next one, basis point value. Basis points means 0.01 percentage. Okay, this is called 1 basis point. This is called 1 basis points. Now basis point value. Now suppose if it is moving up by 0.01 percentage interest rates, then what will be the movement? The movement will be, so basis points value is equal to 0.01 percentage of notional amount. Notional amount into, so this is for 1 year. Okay, because this 0.01 percentage is per annum, na? Notional amount uh, into this is for, proportionately. Let's say we are into the contract for 6 months, so this is for 12 months into 6. Okay, like here 0.01 percentage into notional amount is $1 million divided by 12 into 6. Just calculate this.
Fifty. 50.
Yeah, yeah. 50. So 50 rupees is the change for 1 basis points. 50 rupees, the contract's value will change by 50. So here this will not move highly. This notional amount is making the movement. Okay. Is it fine? Okay.
Sir, what
Yes,
is the basis point? Will you tell us exactly?
Basis points means, see, 1 percentage is 100 basis points. So basically it is like, see, what is centimeter? Centimeter, when you further divide, you will get millimeter, right? So these are like millimeters. This is centimeter. So 0.5 basis points. So you are further dividing percentage. This is 50 basis points. Okay. Then 0.25 percentage is called 25 basis points. Now, when you see news, when RBI comes up with monetary policy, they will say like we have reduced interest rate by 25 basis points, or we increase interest rate by 25 basis points. So they are speaking about 0.25 percentage, because that 2.05 looks like very small number, but it is actually very huge in comparison to the impact that will create across the country. So they will not say like we are increasing and reducing by 1%. For them, 1% is a very big number. Okay, so that means 1 centimeter is a very big number. So the change has to happen only in millimeters. So similarly here also, let's say 0.1 percentage or 0.10 percentage is 10 basis points, and then 0.01 percentage is 1 basis points. This is also in fact highly used in currencies as well, because there also the movement happens highly in currencies. They are doing for millions and billions of dollars, right? So there also slight change in the currency will make a huge difference. One basis is called as, when we will do economics that time I'll tell you, it is considered as 1 by 10,000. That means 0.0001. This level it goes to, because it goes into that minute level. This we will use in currency more actually. Even here also you see the amount is big, $1 million they said, no? Or 1 million euro. Okay, so 1 basis point represents 0.01 percentage. Okay.
Okay, sir. Understood.
Yeah, it is like, see here, let's say you are using 1 kg rice. Now just because you are using 1 kg rice is for certain cooking, but then in that cooking also you have to put very little salt. That means only this much you have to put that salt. So we are dealing now with that small quantity of salt, which is changing the taste that way. So here we are dealing with all these kind of numbers, not percentage. So that's why we have to get well versed with basis points. Okay, fine. Okay,
Yes.
then explain why forward and future price differ. Now forward and futures are doing the same thing, correct? Forward and futures are doing the same thing. So okay, uh, one. Forward and futures are doing the same thing, correct? The only difference is forward is over the counter, future is exchange traded. Then what is the difference between them? Okay, why the prices differ? So the condition is, see, the answer lies on mark to market, MTM. Now imagine if interest rate is going up. How do we calculate, by the way, future value? Future value is equal to what? Present value into 1 plus r raised to n. That means if interest rate is going up, automatically future value will also go up. So if interest rate goes up, if interest rate goes up, uh, future value future value will also go up, and when it goes up, it will immediately reflect in mark to market. Remember, it will if it is exchange traded product, then it will immediately reflect, and you will get daily mark to market settlement will happen, right? So you will get more money. You understood? More as in you will get quickly, you will keep getting money. So in that case, future is better for you. If interest rate goes up, future value will also go up. Okay, assuming they both are correlated. Okay, correlated means if interest rate is going up, here positively correlated. Assuming interest rate is positively correlated to the underlying assets. is positively correlated to the underlying assets. Okay, so that time you should go for future price. Okay, future instead of forward. But if interest rate is going down, imagine if interest rates, imagine there is a correlation, but now interest rate is going down. So if interest rate goes down, then what will happen? Future value will also go down, because imagine here it is minus, and future value will also go down. So future value will also go down. Okay. So in that case, then your future value will go down. So that time, forward is better. Forward is better. Okay, forward is better. Understood? If interest rate is going down, future value also will go down. Then that means money will go out of your pocket in MTM. So that time better you go for forward, because there then MTM will not happen. Mark to market will not happen then. Okay, so here it is mentioned. And if they are not correlated, it doesn't matter. You are taking forward or future. Both are same. Okay. You can read all this. Just you read this, I'll be back in a minute. Yeah. Is it fine? Okay. Hello. Hello. Can you hear me?
Yes, sir.
Yeah.
Yes.
Okay. Okay. Um, this one is mentioned in fixed income in a better way, but still I'll just explain it. See, consider $1 million dollar interest rate futures. Okay, it is future. It is priced at 97.5. That settles 6 months from now. So 6 months MRR settling 6 months from now. So this will be okay. So the forward future price is 97.50. Okay. Each basis point change in the annualized MRR will change the value of the contract by 0.0001 into, okay. That means this is each basis point. So 0.01 percentage into $1 million for 6 months. So this is for 12 into 6. That comes to 50. Now they see when MRR is 2.5 now. So we know 100 minus 100 into MRR 6 comma 6 months, 6 months comma 6 months. So here it is 2.5 percentage. So 100 minus 2.5, that is equal to 97.5. Okay. So now what if the interest rate goes up and down? So if the interest rate goes up, we will get 50 profit. If the interest rate comes, so that means what is the new interest rates? Suppose if the interest rate goes up, so after 6 months, for 6 months, okay, this is 6 months. Now, if the interest rate goes up, so right now it is 2.5 percentage. If it goes up to 2.51 percentage, so see what happens. 50 rupees you will get profit over here, correct? Now, if you discount it, 2.51 percentage, this is for 12 months. We want to discount only for 6 months. Just calculate this and calculate till 4 decimal.
$49.3802.
Yeah, 49.3802.
Yeah.
So if the interest rate goes up, this is the amount. Okay. Now if the interest rate comes down by 0.1 percentage, so we will think, see, 1 plus
2.5 now.
2.49. No,
Okay.
2.5 is the in between one. Interest rate going up and interest rate coming down. Both we are checking.
Okay.
So if it comes down to
Yeah.
2.49 percentage,
Doing
now you check for 4 decimal.
it. 49.3851.
Yeah.
3851.
So if you notice, uh, this number, when the interest rate is coming down, see from 50, from 50, how much it has come? Uh, yeah,
The
when we are
difference?
discounting, when we are discounting, you see 0.1 percentage going up and down. There is a difference in this number.
Yes.
Difference in the sense, see, uh,
Okay, yeah, so it's 5.
when find out what is the difference here. 50 minus 49.3851.
Plus 50. So it's 0.614845.
Yeah,
Like 0.6148.
0.6148.
48. Yeah.
Now here you find out the difference.
15 minus 0.6198.
Yeah. So now you see this is 0.6148.
Mm.
So when the interest rate went up, it is coming down highly. It is
Yeah.
not equally coming down. You got the difference. It is not equal.
Right.
Okay, ideally we would have expected equal amount, correct?
Right.
Because
Right.
this is equally like, you know,
Yeah.
one
1%.
point one 0.01% going up, 0.01% coming down. Okay, so this difference, unequally it is going up and down, right? Okay, this is called as convexity bias, which we will learn in fixed income in a better way. Convexity bias. Okay, this is so the forward also exhibits convexity bias. Okay, convexity bias. So convexity for forward is even bigger, increases for longer period. Is it okay? Fine.
Yes.
Yes, sir.
Oops. Here. Reading 72, pricing and valuation of interest rates and other swaps. Okay, so here you don't have to read all this. These are not required. Too many notations are there. You will eventually understand automatically. So yeah, not required to read all this. This line is okay.
And so we do
This-
also have put call parity and all those things. Right?
Yes, that all are there ahead. Swap fixed rate that gives the swap a zero value at initiation, which is also known as par swap rate, is not difficult. Not difficult is not needed. This line is needed. This much is enough. Now, what is this? I'll explain. See, what is swap par rate or par swap rate? It's a very important term. Okay, in derivatives, yeah, in fixed income also it will come. In derivatives also it is there. But when you learn about swaps, it becomes extremely important one. Okay, now swap par. Why do they call this as par? Okay, see, for example, let's say uh, this will be little lengthy. I mean, extensively, I want to cover this. Uh, okay, see, let's say this is let's find out how to value your bond. Okay, let's say there is a 3-year bond, 3-year bond, and this 3-year bonds coupon is 10 percentage. Okay, coupon is 10 percentage, and uh, interest rate, interest per year is not given. Shravani, you might not know this, right? IY you don't know, correct?
No, sir.
Yeah, so right now you ignore this part. Okay, coupon means interest that you get on your bond. Okay, the face value is, imagine it is 1,000. We have to find out what is the present value, some other information given. Remember, I think I have spoken about spot rate and forward rate, correct? Implied forward rate and spot rate.
Yes, sir.
So these are the information. 1 year spot rate is 6 percentage. 2 year spot rate is 7 percentage. 3-year spot rate is 9 percentage. So now using all this, how do I value the bond? So how to value the bond is, it's a 3-year bond. and 10% coupon. So that means 10% of 1000 is 100. So it will give 100 plus it will give again 100 plus it will give 1100. These will be the cash flows. Okay. And for now I have to calculate the present value. So present value I will discount it with the first year spot rate. 1 plus 6% raised to 1. Just calculate this and keep it in store 1. Just calculate and tell me the amount.
It's 94.3396.
Keep it in store 1. Okay.
Yeah.
Then second one is 7%. This is a 2-year spot rate. 1 plus 7% raised to 2.
It's 87.3438.
87.3438.
38.
Then third year 1 plus 9% raised to 3. Calculate this. This is 1100. Okay.
Yeah, it's 849.4018.
Now you add up all this.
It's 1031.0853. 0853.
Okay, fine. So this is the price. Now my intention is I want to find out
I by 1.
what should be no, not I by Y. I can find out I by Y with the help of this.
PV.
Yeah, present value. I can find out, but that is not the intention now. I want to know what should be the rate here, which should force the bond to be priced at par. That means 1000. See, right now, is it 1000? No. Right now, it is 1031. So I want to know. So, what is the coupon rate? So, you understood the question?
Yeah. What
At
is the
what
coupon
coupon
rate
rate? At what coupon rate the bond will be forced to price? So, rest of the things I am not changing. Only the coupon rate. At what coupon rate the bond will be forced to price at par? Okay. The bond will be forced to price at par. Okay, at what coupon rate the bond will be forced to price at par? So how to find out? So there is a formula for this. So the formula is swap rate or par swap rate is equal to 1 minus Z3 divided by Z1 plus Z2 plus Z3. What is Z3, Z1, Z2? All this. Z1 is the inverse of spot 1. Spot 1. So what is the spot 1 rate?
6%.
6%.
Yeah.
6% raised to 1. Just calculate this and keep it in store 1.
It's 0.9433.
Keep it in store 1.
Yeah.
Now Z2 is inverse of again
Second year.
second year for 2 years. Okay, this is 2 year spot rate. So this is 7%.
Yeah, it's 0.8734.
7% raised to 2. I will also prove this formula. Okay, so don't worry. This formula I will prove it why it is like this. Right now we are just calculating it mechanically. How much?
It's 0.8734.
0.8734.
34. This one is 0.7721.
This is 9%, no?
Uh, yeah, 0.7722.
0.7722, is
22.
it? Okay. So you have calculated all this. Now you do 1 minus recall 3 and store it somewhere. Let's say
One
store
minus.
8, something like that. 1 minus recall 3.
Yeah,
This
stored
is
it.
third.
Yeah.
How much are you getting? 1 minus recall 3.
0.2278.
Okay, you keep it in something like store 8.
Yeah.
Okay, now you do recall 1 plus recall 2 plus recall 3.
It's 2.5890.
Okay.
Yeah.
Now this is, let's say, store 9. So you do now recall 8 divided by recall 9.
It's 0.08799.
So that means 8.799 percentage.
Yeah.
So if I use this percentage, the bond will be forced to price at 100 or par 1000. Let's see how. So 8.799 percentage. Okay. So now let's calculate this again.
That is the coupon rate.
Yeah, that is the coupon. So if the coupon is, if coupon is equal to 8.799 percentage, so the payment would have been what, 87.99, then again 87.99 plus 1087.99. This will be the cash flow from the bond. This is okay.
Right. Right.
Now 1 year, first year spot rate is what, 6,
6%.
7 and 9, right? Okay,
Yeah.
6 percentage raised to 1.
1.0.
Store
Yes.
this.
So it's 83.0094.
Keep it in store 1 now.
Yeah.
This is 2 year spot rate.
It's 76.8538. 76.8538.
Hmm. Here 9 percentage raised to 3. Hmm. This is 1087.99.
Yeah. So 840.1279.
Hmm.
Yeah. So it's coming to 999.9912.
999.99.
9912.
That is, you can round up to 1000 because all these are decimal problem only.
Yeah.
Okay. So, uh, so this is that fixed rate which will force the bond to be priced at par. And also, why are we finding out over here? So that's why it is called par rate. Par rate. And also, why are we finding out over here? Because imagine if there is, remember we learned interest rate swaps. In interest rate swaps, so imagine now, remember I said like this, in interest rate swaps you will pay
There are two
fixed.
companies involved. Yeah.
So you are paying fixed rate and you will receive floating.
Right.
Okay, floating rate. So uh, okay, here floating rate will be what? Okay, so let's calculate that as well. It will be a very full-fledged one. It might be very exhaustive for you, but if you practice this very well, you will get a lot of clarity and and good confidence as well. See, if this is the spot rate, can I calculate the forward rate? Remember how to calculate the forward rate? This is, see, for first year it will be the same. Forward rate, it will be 6% only first year. Okay, there is no change. For second year, what will be the forward rate? That means if I draw this in a graph, it will be like this. For 1 year, 6%. Now for 2 year, it is 7%.
Yeah.
So I want this rate. So 1 plus 7%
Square.
raised to 2 divided by 1 plus 6% raised to 1 minus 1.
Square. Yeah, it's multiplied by 100. Yeah, 8.0094.
8.0094%.
Yeah.
And for this, third year spot rate, third year forward rate. So it will be 1 plus 9% raised to 3
Cube. Yeah.
divided by 1 plus 7% raised to 2 minus 1, correct? How much is it?
Minus 1. It's, yeah, 13.1128%.
13.1128%. These are the forward rates. So if we are entering into an interest rate swaps, you know how the deal will happen. The fixed rate guy will say, look, I will pay you, what is that fixed rate? 8.799. He will say like, I will pay you 8.799 percentage, 8.799 percentage, 8.799 percentage. And floating rate will be, and I will receive initially 6 percentage. And then I will receive 8.00, I think 94, 8.0094.
And 13.11.
And then
13.1128.
13.1128 percentage.
So here the company is in a loss, right?
No, if you calculate, let's prove that also. If you calculate, it will all come to the same amount. So that's why at initiation it is no profit, no loss, zero value. Let's calculate that also. See, let's say if it is, something, if we compare it with bond. So if we compare it with bond, see, swap means what? Swap is a combination of, swap is a combination of, see, you are receiving this interest. So you are long on floating rate bond
Okay.
because it is floating, interest is floating, changing. You are
So,
long on that, you invested. That kind of analogy you have to think. And short on fixed rate bond. This might be too exhaustive for you, but you watch
but
this
then,
again and again.
like for this particular period, I'm paying more, right? 8.799, and I'm receiving 6%. So
Ha,
it's like 2.799 percentage more I'm paying.
ha, ha. But it will not make any difference. I'll tell you why. Uh, see. So you are short on fixed rate bond. That means you have to pay here. So you will pay. So you will pay, if it is like 1,000 rupees bond, you would have paid 87.99. You would have paid 87.99. You would have paid here, uh,
87,000.
and you would have paid 1,000 as well. So 1,087.99. Okay. And if you discount all this with the spot rates, 6% raised to 1, which we have already done, right? This is 7% raised to 2. And this is 1 plus 9%. We are
But
getting how
here we
much?
are the investor, right? Or the issuer.
Ah, it's just an analogy, as if like, you know, you, because you are paying, correct? Because you are paying. So because you are paying, you are short. Okay, and you are paying fixed rate. So you are getting 1,000 rupees here. This is this step fine. The value is 1,000. The value of this bond is 1,000. Okay. Now let's see here as well. See, here you are receiving 6. 6 means what? 60. here 80.094, and here 1031, correct? 131 it will come to. So 1031.128. So now let's discount all this. 1 plus 6% raised to 1. Calculate this. Keep it in store 1.
It's
Minus.
56.6037.
Keep it in store 1. Then 1 plus, this is 7% raised to 2.
It's 6.99.
Okay, so keep it in store 2.
No, sorry, it was 88. I made a mistake. It's 69.9572.
Okay, so you keep it in store 2, that one. Then raised to 3.
There is 1131.128, right?
Yeah.
It's 873.4383.
Okay, now you add up all this number.
Yeah, 999.999.
So that means 1000. So I am paying 1000 and I'm receiving 1000. Okay, so that's why the swap value is 0. Okay, now you ask, now what you said is, it looks like I'm paying 87 rupees and I'm receiving only 60. So it is a loss, correct?
Right.
If that is the case, then you see at the end, you are paying 8.799, but you are receiving 13.1128. So its value is finally all same. So when initially when they are entering into the contract, nobody is at gain or loss.
So when we just add the percentages, like all of these 6 will get 0. Like if we add and subtract these percentages, right? So we'll get 0. Like
percentages.
6% plus 7% plus 13.11, and then minus 8.7.
It will come to 0.
It will come to 0.
Yeah. So let's cross check that also. So you add 6 plus 8 plus 13.1128. Because of time value of money, I think, okay, let's check that one. Time value of money. Let's see if that creates problem. 10
and then
plus
we'll have to
6.
we'll have to be accurate, right?
Yeah. So I doubt if let's see. Let's check that one.
So 6 plus 8.0094. 13. The difference is of 0.7252.
Differences of
0.7252.
That's why I thought like then this time value of money gap will come. So it will not exactly match. But then the amount will exactly match, because in amount that time value of money differences has been rectified. So the amount will match. Okay. So amount point of view, it is perfect.
1,000.
Yeah. Percentage point of view, because when we are adding for different time. 6% is for 1 year, 8.0094 is for 2 years. So that's why you are adding for interest rates of different time period. So that's why that difference is coming up.
Right.
Yeah, it will not match then. Okay. So this is what they have done over here. MRR means that forward rate. That is equal to this.
The forward rate that we are calculating, right?
This one. Forward rate is this
13.11.
This 60, this 80
Yeah.
point.
Yeah.
Okay, that one, and this F stands for fixed rate. Fixed is this one
6%,
87.
7%, and 9%.
Fixed is this one 8.7, 8.7, 8.7.
Okay,
This
okay.
one. This is fixed rate. So finally, both are equal.
Hmm.
Is it okay? Fine.
Yes.
Okay, so this one you should practice as many times as possible, because it will really help you in level 2 also. It will help you a lot in level 1 also. It will help you in fixed income as well, and even in derivatives, these are there. Okay, so we will stop now here only, because this will be too much otherwise for you.
Uh,
Acha, I did not tell you the derivation of the formula. Just give me 2 more minutes. I'll tell you the derivation of this formula. Like,
Okay.
why should you believe in this formula? Okay. Uh, so yeah. So this formula. Okay. So see, present value is equal to. See, this is how we write, right? First year coupon, second year coupon, and third year coupon, and then into future value. This step is okay, like this: coupon, and then coupon, and then the total amount 1000. This step is okay.
Could
Shravani,
you
this
please
step is
repeat?
fine.
Repeat
See,
this one?
present value, if it is priced at par, imagine. So this present value 100 is equal to, see, if it is a 10 percentage bond, how will I write? 100, 100, 100, then
1100.
1100. So this will be, this should be plus, plus. So plus 1000. This is how I will write, right?
Yes.
Par value bond. Okay. So now, if this is 1 rupee, this is coupon plus coupon plus coupon. This is also 1 rupee. Okay. Par value, future value are same. Now, the present value will be, it will be like this: 1 plus S1, spot 1. This is the present value. Here it will be like this. This is the, so this one, this is how I will find out the present value. C into 1, 1 plus S3 plus 1 by 1 plus S3 raised to 3. Because here both are for third year. So I'm taking 3, 3 only here. So this is, so I can give a name for this as Z1, C Z1. So this is my Z1. Okay, plus C Z2. This is my Z2. This is raised to 2. Plus C Z3. Okay, plus Z3. Okay. Um, okay. Now I'll take the common factor out. It is not required for you, because it is not required because nobody is going to ask you the derivation, but it is always good to know. Yeah, I would always, encourage people to know the derivation, because then only your mind
The
should know
bracket,
from where.
it should be Z3 plus 1, right? Okay.
Okay. Now 1
So,
minus Z3 is equal to C Z1 Z2 plus Z3. So now C is equal to 1 minus Z3 divided by Z1 plus Z2 plus Z3, which is what? Our formula. So this is the coupon rate at which here also it is 1,
Yeah.
here also it is 1,
Where,
at the end also it is 1. This is a derivation of that formula, swap,
here
par swap.
PV equals FV, right? That's what.
Yes, yes,
Par. Yeah. Okay.
correct. Okay,
Yes.
Yes, sir.
fine. We'll stop now here. So what I would request you both is just practice this very well. More number of times you practice, think what is happening. Not only mechanically practice, just also think what is happening. Then whatever questions, doubts you get, you just write down all those questions. Then we will discuss in the next session.
Okay, sir.
Fine, okay, we'll stop now here then. Okay,
Thank you, sir.
okay,
Okay, sir.
okay, bye. Bye.